Today, we're going to talk about key IBC terms to know. There is a lot of vocabulary, let's say, or some people would say jargon that's associated whenever they start learning or hear about the infinite banking concept. So today, we're just going to break down a few of the key terms. First, I'd like to distinguish, right, the vehicle for an IBC policy. It's a whole life policy. We're talking about permanent life or whole life insurance, which runs for a fixed term as far as the payments go, but is guaranteed to pay out because it's permanent, right? And as long as you pass, eventually the death benefit will pay. There's no ifs, ands, or buts there. And this is different than, say, term life insurance, where it might be, as short as 1 year renewable or 10 or 15, 30 years at a time. This is kind of like renting insurance or protection. And it's a fixed death benefit that from the first year to the last, maybe it's, $500,000 or $1 million of term. Terms are typically very cheap, but there is zero cash value to them, as opposed to the whole life policy that the IBC system uses. Whole life has the cash value or equity in the policy that you can use as collateral from which you can take policy loans. A third type of insurance, the most recent kind, would be known as IULs or VULs. And stands for Indexed Universal or Variable Universal Life. So these universal life policies came about in the 70s and 80s, when the stock market was on a tear and insurance companies tried to, compete. So those are a different type of insurance altogether that speculates in the stock market, essentially, and has fewer guarantees than the whole life. So another key term is the death benefit. And death benefit obviously is the uh, monetary amount that one stands to be paid out, or not, your beneficiaries do upon the passing of the insured. So the death benefit, is holds for all of these policies, right? That is the main purpose of life insurance, generally speaking, is to pay a premium and have some certain death benefit. Again, the death benefit is static for the life of the term policy, but does grow each year for the whole life policies. Now, the cash value, again, only exists for whole life policies, permanent policies. And that is, again, thought of as the equity, or also known as the surrender value of a policy. And this increases every year with the whole life policies because of the way the premiums are paid in through the base, as well as the dividends that are ever reinvested for IBC policies to buy even more death benefit and cash value. The base premium, as I mentioned, as opposed to the paid up additions. Okay. A lot of people, need to understand the difference. A base premium is really, when they talk about premium, typically it's going to be the base premium. Base premium is the backbone of the policy. It is what keeps the wheels on the bus, as I say, and is the same, or the contractual premium that a policy requires to be paid every year or month, depending on your mode of payment. That serves as the backbone for the policy. It has to be paid. It's guaranteed never to increase on a whole life IBC style policy, but it provides that death benefit from the very first day, and continues to, build in growth through the dividends and that ever increasing death benefit. The other type of premium is paid up addition, okay, or PUA. PUA is different than base because PUA, paid up addition, buys you fully paid up death benefit right away. It increases your death benefit by, X amount. There's a factor, or, an algorithm that determines that. But it also serves to provide a policy cash value right away, right? So you can see base premium and PUA. The distinction, lies in what they do for your policy. The base premium is going to set up that tremendous death benefit, which is, from day one, many, many times whatever your premium is. And, over time does add to the cash value. The PUA serves primarily to flood the cash value into your policy early on from the first, year to the next and for the PUA period, typically for the first 4, 7, 10 years, depending on the build. But that serves to, deliver that cash value right away that you can then use. Um, okay. Loan interest. All right. A note about loan interest. Just know that there are two types you'll hear of loan interest. Aside from the interest rate, which is always based on an annual percentage rate or yield, there's such thing as a simple interest loan or an amortized loan. Okay. Real important here. This is super powerful because simple interest is calculated on your present value outstanding balance. Okay, so if you have, say, a credit card that you pay off, over the course of, say, 6 months, that interest rate is only going to apply on whatever your remaining balance is. So as you pay down the balance in simple interest vehicle, that's going to be a smaller and smaller interest amount. Okay, even though the interest rate remains, it's based off of an ever decreasing, um, remaining balance. Amortized interest is different and much more, well, expensive if you're paying it. And I want you to think of mortgages, okay? 30-year mortgages, 5 to 8 year, car loans, student loans, business loans typically are going to have amortized interest. And that type is, typically going to be for a set number of years beyond one, right? And one key feature of a amortized debt is the fact that there'll be a monthly payment schedule for it, right? And as you pay it down, that monthly payment remains the same. For example, your mortgage. Even if you lump sum, chunk down, or pay extra on a mortgage, you'll see the very next month it's still the exact same payment schedule. That is a key indicator that, hey, this is amortized. The banks have already pre-calculated that interest and spread it out over 30 years, 360 months, or 60 months for a 5-year car loan. Just know that when they do that, the interest is going to be much higher than a simple interest. So that even if you're paying it down faster, it's all going to interest because amortized interest is front loaded. That's the other thing. So in a simple, way to explain it, simple interest is cheap leverage or cheaper. And amortized debt or interest is going to be more expensive because of the nature of that compounded amortization is what they call that. Next, dividend rate. Dividend rate is, every year, each of these insurance companies is going to have a dividend rate. And this rate is just a metric that you can, easily compare companies against. Essentially, for whole life companies, mutual companies, this dividend, right? Let's talk about dividend, right? For most public companies, dividend is going to be that sum of profit each year or quarter, depending, of money that is then shared to the shareholders. Okay, so it's a return of profit. If a company's doing its job and doing well, then that excess profit is shared with the owners. That incentivizes people to buy into the company and whatnot. Life insurance companies, the mutual ones, don't have shareholders in that sense. We have policy holders. Policy owners are the owners of the company and thus get this dividend. However, just know that the dividend with these policies and these companies really are a return of premium. And because of that, it's not profit per se, and thus becomes or is not taxable, which is a great advantage. Okay, so dividend rate, that's what that is. Last, the owner. There are three key players to a policy: the owner, the insured, and the beneficiary. So let's start with actually the insured. The insured person is the one whose life the policy is based on as far as the rating, And, a lot of times the owner is going to be the same person, right? If I want a policy on myself, I would be the owner and the insured, right? Because it's based on my life and health rating. But the owner, I'm controlling that. I'm the one responsible for the payments, and have the right to take the loans and repay them at will. Now, the beneficiary, the owner gets to decide who this is, and it might be a person, multiple people, my children, a church or a university. There's some leeway, or a trust, right? The beneficiary is the recipient of the death benefit, essentially. And again, the death benefit as a cash sum can be split out among multiple beneficiaries, but the owner gets to decide on that. One, you know, one example where all three might be different parties would be, say, a child's policy, where the child, maybe a 10-year-old child, is the insured. You can open that policy on the child. Of course, the child doesn't, know anything about insurance, doesn't have an income, but the parent naturally would be the owner on that policy for the child as the insured. And the beneficiary could be the other children, or, the parents themselves. Um, but, that's those are the three main players in any IBC whole life policy. So owner, insured, and beneficiary. So that wraps up some of the key terms to know. Hope this was helpful, and see you next time.